everybody, Jacob here. Today we're looking at MarketAxess Holdings, ticker symbol MKTX, number 78 in our high ROIC screener. They operate an electronic trading platform for institutional investors. 8.3 billion market cap with a little bit less enterprise value in the capital markets industry. Growth has been pretty substantial. 263 in 2014 up to 753 in 2023. Dividend has grown quite a bit, earnings per share up quite a bit. Operating margin down actually a little bit, but could just be the year as they've been very consistent above 45%. Gross margin at 72%, very substantial. Return on invested capital low 20s. All numbers looking good from initially. Balance sheet shows 451 million. Cash and cash equivalents with 71 million. Short-term investments. No long-term or short-term debt. Very safe balance sheet. Cash flow statement shows very little capital expenditures and a heavy amount of cash flow. Love to see that. What I like to call cash cow. Use of cash, a little bit in reinvestment, quite a bit of acquisitions, repurchasing shares, paying their dividend. Dividend looks to be paying out about 35% of their 5-year average free cash flow. They haven't bought back a whole lot of shares recently, but outside of last year, it looks like they used about 10, 20, 30% for share repurchases, a little bit on the acquisition side. It looks like their cash balance is just going up quite a bit. Okay, let's start making some assumptions here. So revenue side, the last 3 years have been kind of slow. I would say that, like most capital markets industries, the more attractive the market does, the more attractive the company does. And so if it's kind of a laggard couple years, it might, have some trouble. But I think I could easily see them grow a little bit more than inflation. So maybe let's do 4%. They're reinvesting back in themselves a little bit, but they are paying a good dividend, buying back a little bit of shares, making acquisitions. So I don't know how large of a premium I want. So I'll probably be putting 16. So a little bit above market average from what I've seen historically. Share change, I'll probably be relatively flat as they haven't recently bought back a bit of shares. Their margins have been pretty substantial. Let's do 40, 44%. And then on the dividend side, it was paying out about 35%. So they can definitely afford increasing that a little bit. Let's increase that with our revenue growth assumption. And we get to a price that just looks a bit expensive here. And again, makes sense. 32 PE. I'm deflating it to 16. Revenue growth and margins are not out substantiating my 15% discount rate I'm looking for. I just think it's a little expensive at this price, but definitely something I'd want to own later at the right price. Hopefully you enjoy the video. Have a great day. Thank you.